Welcome back to our weekly update. I'm Charlotte McLeod with investingnews.com, and we're going to run through a few of the week's biggest stories in the mining industry. If you enjoyed this video, don't forget to hit the like button, subscribe to our channel, and of course, leave us a comment below. Let's get into it. The gold price was on the rise this week, breaking briefly through the 4,800 per ounce level for the first time since mid-March before pulling back. Silver trended upward as well, nearly hitting $77.50 per ounce. Both precious metals have seen price declines since the Iran war began and were boosted this week by US President Donald Trump's announcement of a 2-week ceasefire. I've been seeing a lot of questions about why gold and silver prices have gone lower and not higher since the war broke out, and I think it's definitely a topic we should continue examining. I heard recently from Dr. Marc Faber of the Mises Institute, who said the decline in gold actually happened because the yellow metal is doing its job. Here's how he explained it.
Our first inclination is that that's going to increase the price of gold. But of course, in terms of market participants, there's a small subset of market participants who are going to want to sell gold at the outbreak of the war, not buy gold. And so people in the Persian Gulf, in the Levant, Syria, Israel, Palestine, Jordan, the Gulf states, we would expect them to be selling gold to finance their governments or to finance their businesses or to raise cash and get the heck out of there. So in terms of emergency, while we're all anticipating in the long run that the price of gold is going up, and I believe it will, in the short run, those people exited the industry, causing an even further downturn in the price of gold. So gold proved to be what it's advertised to be, a hedge against risk and troubled times and all of that. We just have to pay attention to who is facing the greatest risk and what they're going to do about it.
So what does that mean for gold and silver prices moving forward? The broad consensus among the experts I've been speaking to is that the bull run isn't over. Interestingly, some central banks seem to be taking advantage of the pullback, with Chinese gold reserves last month recording their biggest rise since February 2025. But given the global geopolitical uncertainty, it's tough to know when prices will ramp up again. At the time of this recording, the ceasefire was on rocky ground, with Israel continuing to attack Lebanon and the Strait of Hormuz still essentially closed. Oil prices remain volatile, and although they took a hit when the ceasefire was announced, the long-term impact of the strait's closure is expected to be meaningful. One beneficiary so far has been Russia, with calculations from Reuters showing that its oil tax revenue is set to double in April as demand for Russian oil grows. I spoke to Dr. Marc Faber of the Gloom, Boom, and Doom report, who said while he's not particularly interested in buying stocks right now, oil companies do have some appeal.
In 1980, at the last peak of the oil boom of the 70s, when oil had gone from essentially $1 in 1970 to close to $50 on the spot market, at the time, oil and oil-related stocks made up for 35% of the S&P 500. We're now down to around 5%. So I think oil stocks are reasonably good value. I mean, if you ask me, Mark, you must buy stocks today, which I don't really want to do. But if I have to buy stocks, I would buy some oil stocks. But I think I would also buy some mining companies, although I think that the mining stocks are not acting well, that they will go down first.
Dr. Faber is a frequently requested guest, and I was excited to speak to him for the first time. Gold was, of course, another topic he covered, and while he thinks it could go lower, the context is key. He anticipates a broader decline in asset prices, with gold likely faring better than most.
I don't think I'm a gold bug, but in my asset allocation, I've written about this for the last 40 years. I have about 25% of my assets in gold and 25% in real estate and 25% in stocks and about 25% in bonds and cash. And I feel the most comfortable with gold, but I want to stress here that I don't think that gold will necessarily go up in an environment of tightening liquidity, but it may go down less than other items, and it may be relatively safe.
I definitely recommend watching the whole video. I'll leave the link in the video description. M&A is in the air, with G Mining Ventures announcing plans to acquire G2 Goldfields in an all-stock deal. The transaction, worth an estimated $2.13 billion, will bring together G Mining's Oko West project and G2's Oko-Ghanie project, both located in Guyana. The companies say the combined asset will have the potential to produce over 500,000 ounces on a life-of-mine average basis, with first output from Oko West targeted for H2 2027. Also on the M&A front, American Ocean Minerals and Odyssey Marine Exploration said they plan to merge to create a deep-sea critical minerals platform. The companies say the resulting entity will be worth $1 billion and will focus on deep-sea critical minerals research and resource extraction. The leadership team will include former Rio Tinto CEO Tom Albanese. The move comes as critical minerals gain increasing importance worldwide. It also comes as the metals royalty company makes its NASDAQ debut. The firm's plan is to acquire critical minerals royalties and streams, and right now its only royalty is on the Nori deep-sea polymetallic nodule deposit.
Thank you for watching. If you like this video, make sure you hit the like button and subscribe to our channel. We'd also love to hear your thoughts, so leave us a comment below.